AI is a foundational technology. Data science is a foundational technology. It's not a use case per se, which is what I'm saying. You can't regulate a foundational technology. You don't regulate AI the same way you don't regulate nuclear physics.
Welcome to FUMO, your weekly guide to what's new in finance and tech. My name is Ronit Ghosh, and with my partner in crime, Gaurav Dhar, it's a real pleasure to welcome you back to episode 2 of our latest season. We're recording this at the start of February 2024. Zooming in from Singapore is a good friend of ours, Alex Manson. Alex, welcome.
Thank you. Hi, both.
In today's episode
This
with
episode.
Alex Manson, we're going to be discussing AI, artificial intelligence,
Excellent.
tokenization, and the future of finance. We'll be talking about the evolving world of digital finance and how a recovering banker, if I can call you that, Alex, a recovering banker, experienced banker, has sailed into the world of venture and innovation and helping build the future of finance. So the theme of this podcast, FUMO, is for future money, future of finance, and I can't think of a better guest than Alex Manson, who runs SC Ventures, to talk us through this topic. But before we get into the weeds of the conversation, a shout out to our sponsors and our partners, in particular, XVC Tech, our main sponsor. Alex, you run SC Ventures. For the very small number of people in the world who don't know what SC Ventures is, give us your TLDR, give us your blurb on what SC Ventures is. Those three people that live in a cave, in Central America, what is SC Ventures?
Sure. I'm sure a lot of people don't know us, and that's pretty normal because we're pretty nascent. We're very small, but think of us as nascent, as in we were set up in 2018, with a mission to rewire the DNA in banking and financial services. We want to do this by serving clients the way they want to be served, reconciling financial services with society's expectations of what finance does or should do. In order to do this, we work with themes. The themes are online banking and lifestyle, meaning integrating financial services in people's lifestyles as opposed to having them segregated in bank branches. The themes are SMEs, world trade, supply chains, typically not served very well by financial services around the world. And then across the board, we've talked about sustainability before, financial inclusion, green transition, sustainability, and also digital assets, which we'll touch on, which is infrastructure of the future. We build ventures. We build them from the start, and I would say, in large part, we're builders, operators of startups. You can think of us as a startup building startups, and at times we deploy capital in the partners we work with, in the context of either building a venture or implementing a technology or capability which they have and we think is solving a real problem. So that's what we do.
Zoom out, zoom out. Look at the financial services world, the world of money, banks, financial services, and think about what AI is going to mean for that world, as in very simplistically thinking about as an investor or an analyst or a banker or a board member. Is this a good thing for banks or a bad thing? Gen AI and AI more broadly, but Gen AI is what's captured the imagination. Is this a good thing for the bank's business from a financial perspective, from a raw, crude money? Does the banking industry make more money, bottom line, or less money? And how does that pool of money that gets made in the business of financial intermediation, risk management, credit creation, etc., how does that change the shape within like the total pie, but with how's the pie divided up?
Right. Wow. So there's a lot of questions in your questions, and I'll try and
A bit
pick
of a
on them
Russian
all.
doll
But
there, isn't it? Without
but
getting
again,
financial people
yeah,
involved.
yeah.
Yeah.
Feel free to remind me of whatever I'm not alluding, but not covering. The First, is it a good or a bad thing? I'm a tech optimist. I'll tell you it's a good thing. And I'm about to tell you also that it doesn't really matter if I think it's a good thing or a bad thing. It's a thing, which is it's here. It exists. And so irrespective of whether you think it's a good or a bad thing, my strong recommendation is to not ignore it because it's here. And in fact, I think in that post I wrote, it's a little like fire. Once you've invented fire, it's really hard to uninvent it. So you can domesticate it. You can think of the use cases for fire. You can make sure it doesn't burn you if you put your finger in it, or your house if you're not careful with it. But generally speaking, it's here. And overall, I'd say fire was a pretty good thing for humanity once humanity figured out a way to deal with it. So I think there's an analogy here. Why do I think it's a good thing? Because it's a capability that will help financial services, including not limited to banks, serve clients better. And so will financial services on the back of it make more money? Well, my assumption always is that in the long term, if you serve your clients the way they want to be served, then you're going to be relevant to your clients and money comes out of this. There's no business plan that says my business plan is to make $1 billion. My business plan is to do this, solve that problem, help clients in a certain way. And then the $1 billion is hopefully an output of doing things the right way. So to the extent I have a capability that helps me do a better job for my clients, then it will be a good thing as far as making money is concerned, or over time at least. And so that's where I'm an optimist. The point I also made implicitly, I guess, in my post is now taking a step back on what this is. It's AI is a foundational technology. Data science is a foundational technology. It's not a use case per se, which is what I'm saying. You can't regulate a foundational technology. You don't regulate AI the same way you don't regulate nuclear physics or electricity. You can regulate the use cases for it and control the way people are using it. But the foundational technology is here. AI, data science, it's foundational technology, just the same way, by the way, blockchain is. Just the same way they're foundational technologies, and you don't regulate foundational technologies per se, meaning you can't regulate AI any more than you regulate nuclear physics or electricity. You can regulate the use cases associated with this so as to make them safer. And you think of the use cases, but the technology is what it is. It's foundational, and it's here to stay and won't go away. So the implication of this is something from perhaps just from a personal perspective for us all in the industry. I've quipped about this with our friends at CIT. In the days I started in finance, if you didn't know your accounting, you were going to be in hot water pretty quickly. Bad idea for a banker not to understand accounting. Today, not only do you need to know accounting, but if you don't know your data science, I think you'll be in hot water pretty quickly. And so I'm sorry if it sounds a little threatening, but this is how important I think it is, which is it's an integral part of what our business industry is about to become. But it's not a business per se. It's not a use case per se. It is foundational to so many things we'll do. Now, have I answered all of your questions, Ronit?
You have. You said that
Yeah.
it's a thing that we can't ignore. It's like
Yeah.
we invented fire, we invented AI. It's with us. We just need to know how to use it for the greater good. What I want to just double click or go into more detail on is within the world of money and finance, how does it change the landscape? Because whenever you get a new thing arrive, like a disruptive trend, and we've seen this in financial services, right? Say, in capital markets, you could argue the growth of electronic trading or the growth of securitization, the changes in capital rules, new geographies becoming more important, like in the last 20 years, China. That then led to changes in who made the money globally. Um, AI within the financial world, does this help? Like, of course, banks have to, we can't ignore it. But does it help banks or does it help non-banks more? If I'm a fintech, does it help me more than a bank? If I'm a small company, does it help me more than a big company? I was wondering if you have views on how the landscape within the financial services industry gets reshaped.
Yeah, it depends is the answer. I don't know that I would differentiate between banks and non-banks as it relates to AI specifically. I think it's equally relevant for both and perhaps equally a threat or equally an opportunity for both. And between banks and non-banks, I think you almost have to sort of drill down a little further, which is what do you mean? You mean deposit taking versus non-deposit taking, regulated as a payment infrastructure, regulated as a custodian, regulated as as what part of the financial industry you're looking at here, and then as a function of that, what bit of AI you're really contemplating and where it plays a role. So I don't mean to elude the question, but I think it's you have to be that specific, that micro, if you will, to go into this. I what I would say is both for banks and non-banks, there is an expectation that it will change the way we do things, meaning possibly eliminate certain ways of doing things, so eliminate certain jobs, certain activities. It will make some of them better. It's likely to be not binary, but most likely, as in every other industry, a combination of evolving humans with evolving technology and AI, and all of this is an evolution which is happening in front of us and is happening pretty fast. Back to your example about electronic trading, I think a lesson we've learned over some period of time is every time disruption comes in, every time something new happens, right? There's an S curve of innovation, and so that S curve is now visible. It's in place. Some people jump on an S curve and they want to go as fast as possible and be part of it. And some people delay it because I have an existing business which I do not want to cannibalize, for example. And so I want to preserve the status quo because it's good for my shareholders, it's good for my employees, it's good for whatever. There's element of so do I slow it down or do I accelerate? Invariably in that space, I think the winners are the ones who accelerate, go on that S curve as quickly as possible so they can jump on the next one. So they have no choice but jumping on the next S curve, the next innovation curve, and do to themselves what otherwise someone is going to do to them. And so the view I would advocate is if something is going to disrupt your business, accelerate it, because it will force you as an organization and it will force you at times as an individual to think about what's coming next and get ready for it and get on with it essentially. And we saw this in trading. We saw this in the context of new regulations cleaning up balance sheets, and some institutions have done it slowly, some have done it faster, and we know who's doing better today. Et cetera, et cetera. So I think it's no different for AI, and it's no different for digital assets and what we were talking about with Gaurav earlier. Accelerate that evolution, be at the forefront of it, because that's how we acquire the skill set, the muscles. Essentially, that's how we train the muscles to not only cope with that evolution, but actually thrive in it, and on the back of it, do something really interesting and worthwhile, and do it again and again over the years. Yeah.
I want to double click on that theme of innovation, S
Mm.
curves, also bring in like the regulatory landscape, but I want to give Gaurav a chance to explore those. I'm sure you'll be better than me.
Yeah,
So Gaurav, back to you.
thanks a lot, Roy. I mean, Alex, sitting in the position you're in, right? Regulation or regulators is
Yeah.
a is an active part of what you're doing or exploring and deploying, whether
Yeah.
it's front facing, right? And I think we can all agree, the three of us, right, from the different positions we've seen the ecosystem. In the last 10 years, a brand new parallel ecosystem has emerged. It was unregulated to a large degree because nobody knew what was happening in the first place to call it a regulated space. It took form of its own size. It happened at an unreal pace. It created the opportunity for these parallel ecosystems to do good but bad, but also created value. It also created interest, and it also created a whole new job sector where everyone's moving from regulated or unregulated entities, because that's what startups are, right? They're just discovering or pushing the boundaries of the ecosystem. But in the last 2 to 3 years specifically, regulators have started tapping people on their knuckles because they're catching up with understanding the implications within their own capacity of what that impact would be to consumers, businesses, ecosystems, economies, right? And they're moving. And my question to you is, Alex, given your global view and your view of deploying technology, adopting technology, and investing in technology, whether it's a mandate to generate revenue in 1 year or 3 years or become profitable, putting that aside for a second, regulated technology and regulators. Are you seeing regulators really moving that quickly in step with the pace of technology that you would deploy yourself to your customers or other people would deploy in ecosystems? The UAE is a primary example with VARA, lockstep with central bank and DIFC and ADGM and other places. But are you seeing regulators globally in the even larger ecosystems also falling in line and catching up? Or do you think there's still 3 years to go before they can match the pace to some degree for adoption to really take effect?
Yeah. So a bunch of interesting dynamics here, but it's an interesting question. I'm going to try and attack it from different angles. So first, nobody moves at the speed of technology. Yeah? So technology is always going to be faster than you. So including and not limited to regulators. So the first observation I was going to make is no, regulators are not moving in at the same pace as technology, but neither do banks. Right? Neither do you and I, actually. And so, because there's only so much we can pick up. And so what we're witnessing in right now in this industry, which is evolving at a very fast pace, is everyone in different locations of the ecosystem, if you will, everyone kind of scrambling to get up to speed and not be left behind. So it is the regulators. It's also the banks, and you could argue the banks have at least an excuse, which is waiting for the regulator to tell me what's okay, what's not okay. So sometimes, but even then, it's hard, and everyone's a little understaffed because how can you not be understaffed in the context of an industry which is brand new and changing by the day. And so meaning we have a huge job in building talent, building our own talent, and building our own personal knowledges, but also people around us, and making sure this is evolving at pace. So no is the answer, but regulators are not the only one, right? Then there's different regulators around the world, and they move at different paces. And that's, at times it's cultural, at times it's the nature of the organization, it's the nature of the setup. And different regulators have taken also different approaches, right? Am I going to take the existing framework and use it for a new asset class, which is essentially the US, or am I going to develop a brand new framework for digital assets? Think of MiCA in Europe, think of ADGM and VARA. It's we can debate. And then next to the regulatory framework, there's legislative work that is happening as well. So think about ownership again. Think of a number of concepts in law that will need updating. Then there's a number of things that will need updating in infrastructure, right? As I said earlier, it's rails of the future, infrastructure of the future. And so what do you make of CSD? Well, centralized perhaps doesn't make sense in a trustless environment where by definition, all information is decentralized. They've played a great role in creating trust, but that will, regulators around the world and policymakers and all that will need to think of the implications for bits of the infrastructure which they're currently regulated, and some regulators in the world have already sort of mentioned this explicitly, that we will need to think about this down the line because it's important and relevant. So that's what's going on. Part two of my answer, observation on I guess on the back of your question is the back to first principles, right? What a regulator does is ensure that the society at large, the public, the end clients, consumers often are protected. And what it does, what it says on the tin, and so we go back to conduct of business, right? In the first phase of effervescent technology and adoption and early adopters and all that, great things happened. In my mind, a lot of great things, but also bad things. Indeed, bad actors, but also a setup that wasn't entirely appropriate. In some ways, the setup lent itself to the existence of bad actors, because we haven't segregated custody from execution, from settlement, because of certain principles that were very TradFi lessons, hard learned in 1929 and then remediated in the laws of 1933 and beyond, and so good old days, right? Lessons learned over time, which were sort of ignored because, well, it's all different. It's a different asset class, right? Back to principles is my point, right? So what are the principles? Conduct of business, suitability. I will not sell you something for the sake of making money. I will sell you something because you need it. Technological resilience, engagement with policymakers, transparency, segregation of duties. All the things which are sort of maybe not religion, but an integral part of the way we live and conduct our businesses in the financial services industry, and we're not explicitly prescribed in what was a new asset class. And the view I take on this is, whether it's prescribed today or not, well, apply these principles because they're good principles. So high level of integrity, conduct of business, apply these principles, and then regulations will come and you'll be validated by the society.
Can we just double click, focus in on why UAE, and particularly this seems to be quite digital assets focused. Obviously, you're much more ventures than digital assets, but this seems to be quite a heavy digital asset focus to what you're opening at the moment or building here.
Sure. I'll tell you what, so it's not just digital assets, I should say, right? So the first couple of ventures, which I'd characterize as endemic because we built them, incubated them in the UAE, were not specifically focused on digital assets, and we're doing other things too, across the themes I've described before. So across digital banking, lifestyle, SME, world trade, supply chain, sustainability, and indeed digital assets. So it's really across all themes that we think are relevant. And we're focusing on in the context of the future of financial services, or the future of money, as you're saying. But taking a step back, why? I'm going to use the word ecosystem, which is a little overused, so I need to explain what I mean by that. In order to be a successful hub, a hub for financial services, or a hub for tech, or a hub for indeed both, which is a hub for fintech. It takes different actors. It takes a whole ecosystem. That ecosystem includes startups, obviously, but also academia, subject matter experts. It includes policymakers and regulators, and this is perhaps where you're going with digital assets, which exists in the UAE. It also includes a whole bench of professionals who are involved in the ecosystem, from lawyers to accountants to indeed podcasts. It's an integral part of an ecosystem. And I think what we're seeing in the UAE at this point is a very deliberate approach to building that ecosystem. and thinking of all the bits and pieces that it takes to make that ecosystem gel and work. And actually, there's a few places on the planet where that's work. We often talked about the Silicon Valley as that successful sort of ecosystem, and I think a few other places in the world can potentially over time give Silicon Valley a bit of a run for its money. But clearly, there's a very rigorous, methodical approach to building an ecosystem in the UAE, which I find impressive. And we came to essentially be part of that, contribute what we have to contribute, and build successful businesses. Digital assets, as you said, is a subset of it. There are endemic businesses and startups in this part of the world, but there's also a lot of knowledge that is accumulating. There are knowledgeable regulators who have designed frameworks, and all of this is converging to making it a very interesting place to do business in the particular space of digital assets.
Digital assets from a bank perspective, whether it's your parent company or other institutions, what's the interest in getting more expertise, knowledge in digital assets? Where in your existing organization would it help you?
Yeah. So I'll make a first statement, which is high conviction statement. Digital assets are here to stay. Yeah. I haven't said Bitcoin is going up or down. I've just said digital assets are here to stay. And accordingly, if they're here to stay, now there's a few consequences. One of them is that institutional adoption will occur. It is inevitable, right? There's a consequence to that, which is if digital adoption is going to occur, it's going to take digital grade infrastructure that somebody needs to build. And I would argue that we have yet to completely build it. We've started building bits and pieces, but not a whole lot of, there's still missing bits and pieces, and operating at institutional grade is going to be absolutely critical. And we can talk about what I mean by institutional grade. But basically, it's robust. It will comply with regulations. It is trustworthy, and perhaps a little more mainstream than the wave of early adoption, but also the type of infrastructure that people will trust over time. And now there's another consequence of everything I just said now, which is if you're in financial services and you're ignoring a new infrastructure which is built at institutional grade for an asset class which is here to stay, then one, you're not serving clients the way they want to be served. Clients want to hear about it, but they also want to deal with it. And so the risk any financial institution not involved in this would run is to become irrelevant because you're not doing what clients are expecting from you. We're in a service business. We have to be relevant to our clients. And then there's another risk, which is of not doing it, which is we're talking about infrastructure of the future. We're talking about the next generation rails we'll all be using. And so we absolutely have to build the muscles, meaning the skill sets and the bench of people to operate those rails and this infrastructure. And so from the standpoint of the main bank that owns us and backs us, it's absolutely critical. I would argue it's existential that we build that bench and that's range of skill sets across the organization, not just technology, but also risk and legal and compliance and the whole ecosystem again around it, which it will take to operate this infrastructure in a way that everybody will expect us to. That's the point.
Got it. We'll probably come back to that in more detail. Let's get Dara into the conversation to maybe hone in on some of the businesses you're building.
Thanks a lot, Ronan. Thank you so much for joining us today. Alex, I just wanted to ask you, we've been talking a lot about what you're building from a very macro perspective. I want to try and get into a couple of pieces colored by numbers and use cases so that our audience can contextualize the size of what you're doing. and perhaps maybe even apply, because there's some people out there who are building something that might be of interest to you. So to start with, could you tell us about the size of this opportunity? How big is this fund? Because my understanding is you are funding ventures which you are building yourself, and you're also funding ventures which other people are building. So, for example, I would liken you to a construct which down the road in Abu Dhabi is Further Ventures with ADQ. They have a $200 million fund, but they also have a venture studio. So it sounds very similar, if I could put a very fine point to what you're doing. So do you have a separate fund which is X dollars size, which people know about? And then do you have a separate fund for building? Is that how, can you tell us the numbers around these things? It's always interesting to learn.
So it's a good. Thanks for the contextual question, and I can try and compare it to our friends at Further, which is at least from a mindset perspective, I can see a few analogies, which is the convergence of building and investing in the context of either building or implementing. So certainly that mindset is aligned, or similar. We perhaps unlike them or unlike others, I think of us as an evergreen capital as opposed to a finite fund. We have funds as well. In fact, we've announced a fund of 100 million dedicated to digital assets infrastructure in the UAE. And that's a very recent announcement we've made with the IFC. But indeed we have a family of funds where we have investments in third-party startups, meaning the partners we work with. As a separate matter, we deploy capital in the ventures we build. And the ventures, typically we'll seed them. At times we start the ventures as partnerships and JVs. We can do it either way, but sooner rather than later, we make these ventures raise funds. So we not only encourage them, we want them to raise funds and validate themselves both commercially with clients and financially with third-party investors. So as a general matter, the first part of the answer to your question is very little we want to do by ourselves, and involve third parties, right?
Great, thank you so much.
I should say order of magnitude is so digital ventures are reported in the annual report of the bank. And, I can give you rough numbers, which is including everything, so not just SC Ventures, other digital ventures. So the bank has deployed about $1.5 billion in capital across all its digital ventures. A bunch of this is a big chunk of this is a couple of digital banks. Another chunk of this is investments in other people's startups where we cooperate, our partner, and a third chunk of this is the ventures that we build.
And what time frame has this been over? Has this been over 5 years, 3 years, 7 years? It just roughly.
We launched in 2018.
So wow, it's very quick to deploy such a large amount, even if it is in tranches in different places. And the next question I have from that very logically is, you broke up the use case for 2 types of investments that you're doing, one internally, one externally, and the thesis, the parenthesis, which justified you to do that, including $100 million in the UAE starting from Dubai DIFC. Can you give us examples of companies that you've invested on either side? Can you give us the use cases?
So first out, scventures.io, the portfolio is public. So our website says it all. If the ventures are still under wrap, then they're obviously not on the website, and they'll launch when they launch. But the ones that have launched and are scaling are on the website, and so are all the portfolio companies we have in our portfolio. So they now it's going to get a little random. I could pick one of them. We were talking about digital assets earlier.
You're most excited about, right? Or scaling the quickest, perhaps.
So in the digital asset space, we have built a few ventures. Sodia Custody, which is an institutional grade custody proposition for digital assets. We have built Sodia Markets, which is a brokerage business in the context of cryptocurrencies, digital assets. We have also recently announced Libera, which has just tokenized a fund comprised of Singapore government bonds. That fund got rated by Moody's. And so it's tokenization of financial securities and funds. We also have a joint venture in Germany called Swayat, and obviously a number of other things in the pipeline as it relates to digital assets. In building these ventures, we needed to access critical technology, and we were never going to do all of this by ourselves. And so an example of this is Metaco, which provides critical technology to Zodiac custody, which we've integrated. In the process of working with Metaco, we essentially partnered up and thought it was a great company. In fact, we took a long time to not just identify them, but narrow down the list, select them, and really come to the conclusion that they were more than bank and institutional grade. And so we invested in Metaco in the process, and I was on the board of that company until that company sold itself to Ripple, which happens to be another one of our portfolio companies in SE Ventures. So gives you a bit of an example of the ventures we're building, bits and pieces of the ecosystem or infrastructure that it takes to operate digital assets, but also the context and the mindset in which we have invested in others, which is really building that ecosystem of capabilities and partners, and essentially building a theme and asset class on the back of it. The point I would make is within one theme, digital assets is what we're talking about here. You can see how things plug into each other. One is a technological capability for another. Obviously, if you're going to be in the brokerage business, custody is relevant. Some settlement is relevant. Tokenization is relevant. And so while these ventures make a ton of sense in their own right, there's a lot of power in ascending them and plugging them with each other, which obviously is part of the plan.
Just to wrap up our conversation, how do we navigate this world, particularly from a finance perspective, a money perspective, just given how quickly we talked about AI, we talked about digital assets, and a related question, we're our age, maybe not quite as old, maybe more Gaura's age. How would you, in your sort of early 40s, same question, but early 40s, mid 40s, navigate this world we're in? So a kind of question about, I guess, continuous learning, staying open, but how would you do it? This is the last pearls of wisdom for the audience.
Yeah, so first, I don't know if my answer is very different for somebody who's starting, somebody who's early 40s, or somebody who's my old age. I think it's
that in itself is an interesting observation to make.
And the reason for this is, see, the major difference is you and I went to school for a little over 20 years of our lives, or actually,
the blackboards and white chalk and stuff like that.
We were beyond divers, so maybe it's call it 20 years, right? And acquired certain skills, and had at the time the expectation that these skills would be relevant for an entire professional career. And by and large, it kind of worked, right? So, I went off, did different things, went back to school for an MBA, but by and large, you acquire skills early on and then you work. And so we had, not quite like our parents, we had, lived and worked in the same corporation for an entire career, but skills were relevant. My children, who are no longer quite children and studying, their expectations, one of them is in, deals a little bit with computers, others, other disciplines and all that, a little bit with computers, as in machine learning and all that. My children expect to learn skills that will be relevant for about 5 years. But within that 5 years, some of the skills they're learning, they know will not be relevant next year. In fact, when they're pitching themselves for an internship, in all humility, they say, I want to learn everything here, but also I've just seen a few things in my recent studies or projects which I'm pretty sure you guys don't know. and I can contribute that, right? So meaning 5 years is for the basics, for the generic skills, but they're aware of the fact that what they're doing now, people in the industry don't know, and they will equally aware of the fact that in a year from now, that'll be dated and potentially obsolete. So I think in that context, especially if you reflect on technology, it has accelerated. Not only is technology accelerating, but it's the way it accelerates the change in so second derivative, that makes sense, of how we work, the change in how we work. So implication of this is, if your skills are going to be, or at least some of your skills will be dated, if not obsolete, within that short time frame, you have to keep at it all the time. You have to keep at it all the time, and there's a number of different ways of doing it. One of them is listening to everything you have to say, Ronit, and listening to your podcast. Another one could be using the services of CFTE. Another one could be to read a lot. Another ones could be to network a lot. Another one could be to get back to school and do this as you work. And it's an element of very deliberately, consciously, sort of building and rebuilding your skills all the time. And I'd say the mindset, and this is where it's not different for Gaurav, myself, and you, and all of us, is I think it requires an element of curiosity in making the space for intellectual curiosity, and recognizing that what's cool today may not be that cool tomorrow, but what you really think is interesting today and not known will be relevant tomorrow, and making space for that learning, right? And that space may not seem as productive at times, because maybe the path that lead nowhere, and maybe it's not related to the job you're doing immediately and are measured on, but very important to create the mind space to understand what's going on and take the time to think, so you can be so you can be just a little bit ahead of your time and some of the people around you. Maybe I would have said this 20 years ago, but it's become so existential now, right? So that intellectual curiosity.
Take time to think. I like that one.
Right. Yeah.
Take time to
with
think.
with a commercial bias, right? If you're just intellectually curious for the sake of being curious, then you're going to be in academia, which is great, but you will not be in business. But if you're intellectually curious with a commercial bias to it, now you're a leader in business, and that's what presumably a lot of us on this conversation aspire to.
It's been a pleasure, Alex, to host you. A big thanks from Gaurav and myself for coming on this CFT
Thank you, Gaurav.
podcast, FUMO, Future of Money podcast, and also a big thank you and shout out to XVC Tech, our sponsors, and all our ecosystem and community partners. Some of you are coming on board as we speak. I look forward to Gaurav publicizing that more in future episodes. So thank you so much. Over and out.